Good morning. Friday Focus, Friday the 22nd of January. Oh my goodness, we're nearly there, nearly the end of January. For accountants, that's quite a big deal. This year it's been really tough, actually. People have been leaving things very, very late, hoping that there's going to be a deadline extension, but there is no extension. But actually, having said that, we had a letter as an agent yesterday from Jim Hara, who's the head of HMRC, basically saying that if agents did not have the time to submit their tax returns for their clients by the 31st of January, as per normal, due to COVID, due to not being able to get information, etc., the penalties would not be chased up. Doesn't mean to say that they won't be issued. They probably will be issued, but then you'll probably have to appeal. But my advice would still be to get your tax return in as quickly as possible. So today we are going to talk about tax, but we're going to talk about tax for next year. And I know you don't want to think about tax for next year, but I want you to. I just want you to think about it for a little bit. Think about the fact that maybe this year you left it quite late. Not late as January, but maybe you didn't get it done till November, December. And yeah, that's still okay. That's still pretty good. But how would it feel if you actually had it done by May, June? Feel pretty good, wouldn't it? So what we're going to go through today is 10 tips which might help you. It was going to be 5 tips, but I increased it to 10. 10 tips to help you get onto your tax return early. Get onto your accounts early so that you can get it all done. But before we actually do that, anybody who is watching, please comment. No, Piper, sorry. Oh, geez. Hang on 2 seconds. Piper, you shut up on the phone. God's sake. So sorry. Dog taking over as per usual. Yeah, sorry, what was I talking about? So yeah, we've got just over a week to go for the tax return deadline. What I was saying is anybody who's on here, please comment so that I can see who you are, and yeah, just say hi. So if you haven't got an online account, this is your first year of tax returns coming up, then you have a deadline for filing a paper tax return of the 31st of October anyhow. But if you can get it online, it's going to be much quicker and also you've got until the 31st of January next year to submit it. I would not leave it that late if I was you. In order to get an online account, you obviously have to apply to HMRC online. If you've got your unique tax reference number because you've already registered for HMRC for self-employment, then you can use that to get your online paperwork, get your online account up and running. You cannot file your tax return online without having an online account, unless you have an accountant. Secondly, gather your paperwork. So before trying to fill in any forms or anything else that you might have from HMRC or spreadsheets or anything like that, then you need to get hold of your paperwork. So you may need to get hold of your P60 if you had if you were employed by a company during that tax year. So the tax year runs from the 5th of April the 6th of April 2020 until the 5th of April 2021. So you will get a P60 from the company that you work for, your employer. You will receive a P60, should receive a P60 around April, May this year, roughly speaking. Once you've got it, keep it, file it. If you've got a digital file for all of your paperwork, then pop it all in there, scan it and file it. If you've left a job within the last tax year, then you'll have a P45. Again, scan it and file it. If you've got a P11D, if you have expenses and benefits through your employer, then again, you'll have that in probably May. Scan it, file it. Make sure that you've got all of these things. If you are running a small business, whether it's a limited company or a sole trader. If it's a sole trader, then make sure that for a start, you're claiming for every expense that you can. Now, if you want advice about what expenses you can claim for, put in the comment box expenses, and I will send it to you. I'll send you a list of all of the expenses you can claim if you are a sole trader or a limited company. So actually say expenses sole or expenses limited, whichever you happen to be. Hi, Martin. Lovely to see you. I hope you're okay. So yeah, that's your P60, your P45, and your P11D. You'll also need copies of all of your interest, your bank interest or your building society interest, and copies of any dividend payments that have been made to you. If you are not using a cloud accounting system, then you'll need to make sure that your spreadsheet is completely up to date with every single entry from your bank account for that tax year. Every single entry. Every single entry has to be categorized to whether it's print and stationery or postage or travel and mileage or insurance or bank charges, or it doesn't matter what it is. Do it in the spreadsheet and then either work it all out yourself or get yourself an accountant. I would not suggest trying to talk to HMRC, especially not at the moment. Not if you want to hold on to your sanity, that is, of course. Apparently, HMRC only answered 50% of their calls in the first half of last year. In the second half, I dread to think. I don't think they've got any statistics, to be quite honest with you. But it used to be that you waited for 10, 15, maybe 20 minutes, and that was the absolute most. At the moment, you can be waiting for 2 to 3 hours to speak to anybody. They have a web chat on their website. If you look up HMRC web chat self-assessment or sole trader or corporation tax or payroll, or whatever it is that you happen to want to do, it'll give you a different web chat for each one. Now, the self-assessment one, I was on there on Monday trying to get hold of them for a client, bearing in mind that I'm an agent. I have an agent account and I can call HMRC at any time about any of my clients, but they don't answer. So I went on the web chat on Monday. It counted me down from being 795th in line on Monday morning. By the time I got through to them, because you can leave it up on your screen just working out in the background, by the time I got through to them, it was Wednesday at 11 o'clock. Now that ran all night long, 2 nights. It's unbelievable. I know it's January and I know it's HMRC, but anyhow. So if you can avoid that stress by using the web chat, if you can, or looking it up, whatever the information is that you want to know, or asking your accountant if you've got one, if there's anything that you need to know particularly. Bear in mind that your accountant will be quite busy for the next week or so. The most stress-free way of filing a tax return is to get somebody else to do it for you, on the condition that you give them all of your information when they need it, not in dribs and drabs, if you can possibly help it, in one full swoop, which is why I suggest that you gather all your paperwork together. An accountant will be able to deal with that, be able to sift through all of your paperwork, making sure that you've got everything that you need, etc., reasonably quickly. Every accountant will be charging a different amount. So honestly, you'll just have to ask them what they want. I don't just do compliance work anymore. I do a lot of advisory work as well. So I don't take on just tax returns, apart from for friends. I don't take on tax returns and accounts just like that. I now look at your accounts moving forward because I think it's more important than looking back. And the compliance is compulsory. We have no choice about to do that. But hey, that's how it goes. So learn from your mistakes. Learn from your mistakes is absolutely crucial. If you've spent hours hunting in the house for essential paperwork, copies of bank statements, all the rest of it, don't do that again. Don't do that again. Just keep an eye on where it is. Put it all into a digital file. Do you need to fill out a tax return? Well, you've got to fill out a tax return if you are self-employed, if you work as a sole trader, if you're a partner in a business, or if you're a company director, unless it's an unpaid position, of course. You'll also need to fill one in if you're employed and pay taxes through PAYE, but also earn self-employed income. There are other circumstances like having property. You will need to do one if you have property. If you or your partner earn more than £50,000 a year through a PAYE thing and you need to claim child benefit, then you have to fill out a self-assessment form to pay some of that benefit back. If you're not sure, then check on HMRC's website. They've got quite a good checking thingy. What's it? What do I need to declare? This is a really good question. It's a question I get asked an awful lot. You have to report everything that you have earned over that tax year from the 6th of April to the 5th of April the following year. This includes income from your employment, self-employment, property, interest, gains on your savings and your investments, everything like that. Even if all of your savings and investments are tax-free ISAs, you still need to report them. You won't have to pay any tax, but you do still need to report them. If you're a sole trader or self-employed, you'll have to pay Class 2 national insurance. This is a contribution of, I think for 1920 it's £3 a week, and for 2021 it's £3.05 a week. This is paid with your tax at your year end if your net profit is over a certain amount if you're a sole trader. If you earned more than, I think it was 6,300 in 2019-20, then you also then you have to pay the Class 2 national insurance. If you earned more than 8,632, don't ask me how I know that number off by heart, then you also have to pay what's called Class 4 national insurance, which is 9% of your profits between that 8,632 and 50,000. If it's over the 50,000, then you have to pay 2% on those profits as well. It goes up and up and up in increments, basically. The tax rates for 1920, most people have a personal allowance of £12,500, and that's how much you can earn before you pay any tax. This is deducted from your total earnings for that year. The basic rate of tax is 20% up until you've earned £50,000, and then it's 40% in between £50,000 and £1 and £150,000. If you're earning over £150,000, then your tax rate is 45%. If there are some exceptions for all sorts of things. Dividend tax for basic rate taxpayers is only 7.5%, and you get £2,000 tax-free dividends if you're a limited company and you're a director receiving dividends. After your higher rate, then you're paying 32.5%. So you're still paying less than tax, because you're paying 32.5% as opposed to 40%. So it does make quite a big difference. So let's go on to the 10 tips, because we haven't got a lot of time to do this. So there are certain things that you can do to cut your tax bill down, which will make life a bit easier and cheaper, hopefully, for you. So 1, claim extra pensions tax relief. There's a lot of confusion about the technicalities of tax relief, but it means 15% of higher rate taxpayers have no idea whether or not they are getting 40% relief. If you have a trust-based workplace scheme, higher rate taxpayers get 40% tax relief automatically. The same is true for other workplace schemes run through salary sacrifice. So you need to find out from your employer whether or not what you've got. Otherwise, you're probably getting a tax relief at 20%. And you need to reclaim the difference on your tax return. So the difference between the 20% and the 40% on your tax return. When you're claiming the extra tax relief on a pension, make sure that you are entering the gross value of contributions. This is not just a total of the money you paid in, it's the total of everything you paid in plus the tax relief of 20%. Claiming gift aid. Ticking a box on your gift aid means the charity can reclaim 20% on your donation from the taxman. But if you're a higher rate or additional rate taxpayer, it doesn't stop there, because you can reclaim the rest of the tax on your donation through your tax return. Only 20% of higher rate taxpayers actually bother to do this, but it can really add up, so it's worth it. Check if you are better off claiming the flat rate. If you're a sole trader, you have 2 options for claiming the cost of use of your home and your car for your work. You can calculate what you spend on it for work purposes, or you can claim a flat rate. It's completely up to you. Once you've worked out what you actually spend, you can use what they call the simplified expenses checker to see the best way to claim that. That's on the gov.uk. I think it's gov.uk/simplified-expenses-checker. Make a charity donation now to reduce your tax bill for next year. If you've got cash spare, You can make a donation now and use it to reduce your tax bill for 2020-21 because you can claim it on the previous year's tax return. This is particularly useful if you've paid a higher rate or additional rate tax last year and a lower rate this year, because you get more tax relief on your donation, which is great. Invest in an enterprise investment scheme or an EIS now, and you have it treated as made last year. EIS schemes offer 30% of tax relief to encourage adventurous investors, I have to read this bit, to invest in younger and smaller companies. Generally, you get this relief to set against your income in the year you invest. But if you're paying a lower rate of tax this year, or your tax bill for this year isn't big enough to claim all the relief, you can set it against the income for 1920. It is worth highlighting these investments are only suitable for investors who are prepared to accept a high level of risk and should never be considered for the tax benefits alone. Don't forget to divide joint accounts. A lot of people don't do this. It's amazing, actually. If you've got joint stocks and shares account, bank accounts, dividends, etc., you need to split those by the number of account holders. So usually they'd be split 50-50, but not necessarily. It totally depends. So you only put your share on your tax return, and the same with joint bank accounts and things like that. Don't overlook the expenses you can claim for. As I said earlier, good morning, Denise. How are you? As I said earlier, if you would like a list of the expenses that you can claim either as a sole trader or a limited company, pop in the comments expenses sole or expenses limited, and I will get them over to you. Think about the certain expenses that you might already be claiming for or not be claiming for. If you subscribe to magazines or newspapers for work, you should be claiming these as expenses. You can also claim for any clothing you use exclusively for work. Sadly, this does not include suits, even if you only ever wear them for work, but clothes with your work logo on, uniforms and protective clothes all count. Check you're not on the official list of exceptions. This is really, really important. Thanks to a lot of quirks in the system, there are a number of circumstances that means the online self-assessment calculations will not be accurate for you if you don't submit it online. You'll probably already know if you're on this list. If you fall into any of these categories, you'll need to submit a paper tax return, but they will send you a letter about it, so I wouldn't worry too much about that. Correcting previous years. This is really, really big. If you realise that you've made a mistake in previous years, you can claim a refund for overpayments for any time during the past 4 years. You'll need to write to HMRC, and that could take quite a long time to be answered, explaining that you're making a claim for an overpayment relief. Include proof, a signed declaration saying that the details you've given are correct, and outline how you want the repayment to be made, i.e. into what bank account, etc. I'm going to say it again, learn from your mistakes. This is a different learn from your mistakes. This is when you're inputting gains from stocks and shares, if you are in your tax return, possibly discovering you're going to have to pay capital gains tax or even dividend tax. It depends. It's a helpful reminder that you held these assets in stocks and share ISAs. Sorry, Papa's going mad in here. There would be no tax to pay. Even if your gains fall within the annual allowances, details of assets outside an ISA have to be included in the tax return. So this should be a reminder that if you were to move it into an ISA, you could avoid having to include them in the process every year too. Once you've got your tax return out of the way, it's worth making use of any ISA allowance you still have for this tax year. I apologise for the dog going completely mad and taking over this live totally today. I hope that has been reasonably helpful for you, and it's given you some nice little snippets with any luck. Denise, I will make sure that those claimable expenses list is sent to you as a sole trader. That's not a problem at all. Anybody watching on replay, please put #replay. And if you would like a copy of the expenses, put expenses sole if you're a sole trader, or expenses limited. I love the puppy too, Denise, but she is being a complete pain in the what's-it today. She's now just taken my coat off the side and she's looking in the pockets for all her treats. She's not going to find them, but she's looking for them. Blasted dog. Anyhow, I've been on for quite long enough today, and I do apologise. But if it's been helpful, Martin, I will send those to you as well. That's not a problem. If this has been helpful, please do make a comment. It would be lovely to hear from you. And I hope you have a lovely weekend, and I see you next week. And I will be talking about my new challenge coming up, my new challenge, which is going to increase your profit astronomically. Speak to you soon. Bye.